Has some of your investments been crushed this year? Would you like to invest in a business that's been barely scathed throughout 2020? Like the idea of collecting a market-beating dividend that's still growing during the pandemic? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel. I'd really appreciate it. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a crucial part of the global food supply chain. All of that food we're eating requires ingredients, and this company is one of the companies when it comes to ingredients. In fact, it's right in their name. People have to eat, and this company profits from that simple truth. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Ingredion Inc., which appear to be trading at a significant discount today. Ingredion Inc., stock ticker INGR, is a leading worldwide ingredients solutions provider. Founded in 1906, Ingredion is now a $5 billion by market cap global business that employs 11,000 people. The company turns raw materials like grains, fruits, and vegetables into value-added ingredients and biomaterials for various industries. They also provide products for the animal feed and corn oil markets. Some of their products include industrial starches, high fructose corn syrup, dextrose, and refined corn oil. Fiscal year 2019 sales are geographically segmented as follows: North America 62%, South America 15%, Asia Pacific 13%, and Europe, Middle East, and Africa 10%. Product categories are as follows: starch products 46% of fiscal year 2019 sales, sweetener products 36%, and co-products and others 18%. This company is uniquely positioned as a crucial part of the global food supply chain. It's a simple business model, but it's one that's been making money for more than a century, and I see no reason why that can't continue for another century, which bodes well for their ability to continue paying a growing dividend. As it sits, they've increased their dividend for 10 consecutive years. The 10-year dividend growth rate is an astounding 16.2%. However, recent dividend growth has slowed markedly. The 5-year dividend growth rate is half of the 10-year dividend growth rate, for example. On the flip side, the yield has risen as the dividend growth has slowed. The stock now yields 3.3%, which is more than 120 basis points higher than the stock's own 5-year average yield. That yield is also quite a bit higher than what the broader market offers. And it's supported by a payout ratio of 50%. I'll quickly note that I regard a 50% payout ratio as a perfect payout ratio, as that represents a perfect balance between retaining capital for growth and returning capital to shareholders. These numbers are just plain solid across the board. These metrics might not wow you in any particular way, but a market-beating dividend that's growing like clockwork can quietly perform magic over time. Looking at business growth, Ingredion grew its revenue from $4.367 billion in fiscal year 2010 to $6.209 billion in fiscal year 2019. That's a compound annual growth rate of 3.99%. I usually look for a mid-single-digit top-line growth rate from a fairly mature business like this. Ingredion pretty much delivered. Meanwhile, earnings per share increased from $2.20 to $6.13 over this period, which is a compound annual growth rate of 12.06%. Buybacks that reduced the outstanding share count by about 12% over the last decade helped to propel some of this excess bottom-line growth. In addition, fiscal year 2010's earnings were depressed after coming off of the Great Recession. The long-term picture here looks great, but growth has been flattish over the last 5 or so years. Looking forward, CFRA believes that Ingredion will compound its earnings per share at an annual rate of -1% over the next 3 years. It looks like the big picture here from CFRA's perspective is that Ingredion's tailwinds and headwinds are almost evenly matched over the short term. On one hand, there's the secular decline of high fructose corn syrup, COVID-19's impact to Ingredion's food service exposure, and the commodity-like nature of the core business model. On the other hand, the demand for the company's natural sweeteners should increase. The company's growing portfolio of specialty ingredients offer greater pricing power, and investments in plant-based proteins position the company for growth. Regarding the latter point, Ingredion recently announced that it will acquire the remaining stake of Verdient Foods Inc. that it didn't already own, which means Ingredion will produce concentrates and flours from peas, lentils, and faba beans. There's also a cost savings program that Ingredion initiated in order to reach $125 million in savings by fiscal year 2021. I think it's worth pointing out that the company has marched through the pandemic admirably, coming out relatively unscathed. Fiscal year 2020 Q3 results showed a 4.5% drop in year-over-year revenue and a 7.5% drop in year-over-year GAAP earnings per share. With a once-in-100-year type of worldwide disaster currently playing out, this is impressive stability from Ingredion. CFRA does admit to low visibility when it comes to Ingredion's short-term growth, and it would make sense to be prudent in that case. I do think the company's long-term growth could easily be in the mid-single-digit range, if not better, and that sets the company up for similar dividend growth, which would be layered on top of a safe 3% plus yield. Moving over to the balance sheet, the company has a strong financial position. The long-term debt-to-equity ratio is 0.65, while the interest coverage ratio is almost 8. Notably, unlike a lot of other businesses I follow, Ingredion's balance sheet has not swelled or deteriorated in recent years. The debt position is roughly flat compared to 5 years ago. They remain flexible. Profitability is really solid, especially considering that some areas of the business operate in a commodity-like fashion, and Ingredion's growth in specialty ingredients could improve these numbers further. Over the last 5 years, the firm has averaged annual net margin of 7.28% and annual return on equity of 17.46%. This is an under-the-radar business that has held up very well throughout the crisis, and they're making moves to position the business even better in the future. With global scale and pricing power in a growing portion of the product portfolio, Ingredion does have competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Volatile input costs can affect profitability, as does currency exchange rates. High fructose corn syrup makes up a little less than 10% sales, and this product has faced backlash out of health concerns and is in secular decline. I also see a rising risk in the sense that there's a trend moving towards simpler foods with less ingredients, which would not benefit Ingredion. Overall, balancing everything out, I think Ingredion makes a lot of sense as a long-term investment when the valuation is attractive. With the stock down 22% from its 52-week high reached in February, I think the valuation is now attractive. The price-to-earnings ratio is 15.3, which is well off of the stock's own 5-year average price-to-earnings ratio of 17.3. It's also well below the broader market's earnings multiple. Then there's the disconnect on cash flow. The price-to-cash flow ratio of 6.9 is much lower than the 3-year average price-to-cash flow ratio of 10.6. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. This dividend growth rate can look aggressive or conservative. It all depends on which way you're looking at it. Compared to the 10-year earnings per share growth rate and the 10-year dividend growth rate, it's conservative. However, when you compare it to more recent business growth and CFRA's near-term earnings per share growth projection, it looks aggressive. The truth might lie in the middle after we split the difference. I believe it's a balanced and reasonable long-term expectation from Ingredion when looking at the big picture of the business. The dividend discount model analysis gives me a fair value of $91.31. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Ingredion as a 5-star stock with a fair value estimate of $120. CFRA rates Ingredion as a 3-star hold. with a 12-month target price of $81. Again, I came out in the middle. Averaging the three numbers out gives us a final valuation of $97.44, which would indicate the stock is possibly 26% undervalued. Here's the bottom line, guys. Ingredion Inc. operates as a crucial player in the global food supply chain. Recent investments in specialty ingredients and plant-based proteins position the company for new growth avenues. With a market-beating 3% plus yield, perfect payout ratio, double-digit long-term dividend growth, and the potential that shares are 26% undervalued, this is an under-the-radar stock that Dividend Growth investors ought to take a good look at. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.